Welcome, everybody, to the Chinchilla Pickin' Podcast. It is October the 1st, 2023 at 3:08 p.m. As always, we hope to be entertaining, educational, and uplifting because we want everyone to make money. My name is David Underwood, and I am joined by the Baron of Bonds, Brandon Beaver. How are you, man?
Cowboys lost last week, so I'm hoping they make up for it this week. Dak was exposed. I've predicted this constantly on Facebook. He's not a good quarterback. He's mediocre on his best days. And that team is saved by its stellar defense. Last week, they had a bad defensive game, and therefore they lost because they don't have a good quarterback. That's my opinion, but it's just how it is.
Gotcha. Well, thank you for the football update on our stock and investing show. We appreciate it. I will say this, guys. Since we're talking about sports, let me do a little interjection, a little promotion. I don't know if most people listening, Americans at least, know that there's a collegiate boxing league for colleges. They just had a September meetup this past weekend between Army, Navy, University of Cincinnati, Ohio State, and Miami University this past weekend here in Cincinnati. And all the University of Cincinnati combatants won their matches. UC went 3-0 with their combatants in there. Army, Navy had a good couple matches against each other. It was a great matchup. I will say that there's a local high school kid. He is still in high school. He's been boxing for a number of years. He went up against the NCAA champ from last year from Army. And he beat him pretty steadily in the ring this past Saturday. And this is a high school kid. He's still in high school in Cincinnati. So big things expected for him. Congratulations, Peyton. Way to go. So just want to put that out there since we're talking about sports.
Is this collegiate boxing league, is it televised?
No. Okay. I wish they had that kind of funding. Hope maybe soon Chinchilla Pickin' will sponsor some of these events and show up, but or maybe we'll sponsor a YouTube page and go ahead and televise it for everyone to see. But yeah, it was a live event. It's a good event. I don't know if a lot of people are aware that these things happen. And the team that won the championship last year, the team was Air Force Academy.
Okay.
But there's individual winners, and everybody gets points and it goes towards your team competition. So Air Force Academy won the team competition for the men's and there's different winners, but UC is actually very strong. So
nice.
Yeah. Didn't know that. Did you?
How do you do team boxing? Like team wrestling?
It's same thing as team wrestling. You get points. Like if your player gets first place, you get like 10 points. If your player gets second place, you get like 8 points or 7 points or something like that. You know what I mean? And then which team has the most points by the end of the competition, that's the winner. So on and so forth. Follow me?
Yeah.
All right, cool. Well, let's get into stocks and investing, shall we? Let's talk about some companies and actual news that's happened this past week because that's what everybody's listening for. So Rules. Brandon and I get together 5 to 10 minutes before the show, and we tell each other what we're going to talk about. We actually hear the live discussion here on the show. Brandon is going to head us off with a very interesting topic. You went into it, and I asked you to pause because I liked where it was going, but I didn't want to know the gritty detail until we got into it because it sounds very interesting, and I want to see where you're headed with this. So go ahead, Brandon.
Okay. So I started out my research on this show. I was initially going to do like a battle of the billionaires or battle of the hedge funds kind of thing. But when I got into the second company that I was looking at, the second hedge fund, I noticed a reoccurring trend in a specific industry that's been happening over the past year. First of all, I was looking into Greenlight Capital, which is owned by the CEO of it is David M. Einhorn, who is not from the first Ace Ventura movie, not Finkel as Einhorn fame. But he actually gained fame by shorting Lehman Brothers prior to its crash in 2008. Einhorn, like I said, he's the founder and president of Greenlight Capital. which is what's called a long short value oriented hedge fund. This means that they buy stocks for the long term, but they also short stocks as well. And long short equity investing from investopedia.com is it's a strategy of buying and shorting stocks to reduce market risk, maximize returns in a portfolio. And so by shorting stocks as well as buying them, the portfolio has a potential to increase even in a down market. They just released their earnings a couple of months ago, and from the shareholder letter, they said that recent inflation readings have shown a noted deceleration, and the tailwind from higher rents is likely to dissipate, causing core inflation to fall further. And then he goes on to say, even so, we believe inflation is stickier and more entrenched than the market is currently appraising. But they go on to say this: the economy appears to be on strong, solid footing. Employment is strong, wages are growing. Higher short-term rates mean more interest income for households. He says most household borrowing is fixed. And then he says long-term rates remain low, which enables corporate investment and purchases of consumer durables such as houses and cars. And this is a different perspective, to say the least. And on the surface, it seems like a head scratcher, because I almost had to kind of recheck the date of the letter that I was reading just to see, like, is this really from 2023 when he's saying he's enabling consumers to purchase durables such as houses and cars, but yet you see the home sales declining. What do you think about what he's saying here? Because I've got some stats that kind of lean against what he's saying. But what do you think, Dave, about what he's saying here about housing and car purchases? Because it does seem, at least on the surface, to go against the numbers that we're seeing on almost a monthly basis right now.
Yeah, housing and car purchases. I disagree with him, and I have a strong disagreement. And most of the retail CEOs on the last earnings calls all say that there's strong headwinds in the future. I actually have an article talking about that I'm going to bring up later on that goes into this some more. So there are some headwinds. I disagree that it's going to be strong for household purchases going forward. Now, there's also data that's showing that housing prices will start going up soon. I disagree with that. Those are articles I've read too, that they're saying housing prices are going to go up no matter what. And because I see housing prices falling right now, and I don't know where they're getting their information from, but they may be selective about the markets you get it from. So whenever someone comes on and says, hey, I'm looking at the housing market, the housing prices are going to go up, or the house price is going to go down, you have to say, where are you getting your numbers from? Because if you're looking at LA and San Francisco only, or if you're looking at Austin, Texas, and Phoenix only, and you're not looking at Cincinnati, Ohio, or, St. Louis, where's your data coming from? Or did you do a study of just this one geographical area? Because that's going to skew your data. And that's what a lot of these people do, because they're trying to prove a point to get you to invest a certain way. Not everyone, but some people are. And so they will collect data from a specific point, specific aspect in order to do that. So you have to be careful when you're reading these articles. You have to understand who the author is, who the author worked for, and what's the point they're trying to get across.
Right. So the home builder that they've invested in is largely in Texas and Florida, and I'll get into who that is here in a little bit. But the Miami housing market and the Texas housing market have been relatively hot comparative to the rest of the country.
Yeah, so you just mentioned that they've invested in a home builder in certain markets, and that tells me everything I need to know. So that's it. I mean, this is why when an analyst or a hedge fund manager, when they go on Bloomberg or CNBC or any of these channels, they have to list what their possible, what's the word I'm looking for?
Tailwinds.
No, like, do they own it? Does their family own it? Does the company they're speaking for own it? Any type of those things that can be conflict of interest in what they're saying. And so it sounds like this company they just bought in, they own some home builders, and they want to pump up the price.
Speaking of regional, I just kind of did a dive into Ohio, and this is from Ohio Realtors, where we're from. So that's why I was looking at it. Home sales in August of 2023 reached 12,730, which is a 17.2% decline from 15,380 sales recorded during the same month a year ago. Average sales prices in Ohio reached $285,305, which is a 6.6% increase from $267,610, which was in August of 2022. And Ohio Realtor President Ralph Mantica says August's home sales reflect market dynamics of higher mortgage rates, lower inventory, and Ohio's real estate market continues to demonstrate its resilience, evident in the ongoing increase in home prices, highlighting consumers' confidence in home ownership as a wise investment. I'm not really sure that this actually has anything to do with consumer confidence. I think it has more to do with how crazy low interest rates were before, and how tightly current homeowners are trying to hold on to their houses and not sell them, which is deflating the inventory of existing homes. And that's, I think, the only thing that's really holding up the prices of the housing market right now. And if you look at this from a national perspective, single family homes fell more than expected in August, as the rate on the popular 30-year fixed mortgage jumped above 7%, driving potential buyers to the sidelines, which is crazy because Bill Ackman was on that Delivering Alpha conference, I think, just about a month ago. He was talking about the 30-year rate being at about 5%. And he said it could jump up to 7% very quickly, and it did. But August sales of existing homes weakened by 15.3% nationally, year over year. I found it a bit odd that he was talking about strong home sales. It was published at the end of quarter two, and we don't have a representative here to comment about the letter, but I was very curious as to where he was getting these numbers. Now, Green Brick Partners, that's the home builders that they own. That represents 44% of their portfolio now. That's 16,600,000 shares. Now that's the result of almost an 85%, 90% year-to-date gain on this company. That represents also most of their gains in their portfolio. So, of course, the gain in this stock is partially to be blamed, or I don't know if you want to say blamed, but you can point to that as the reason why it's such a large percentage of their portfolio.
All right, so I just pulled up Lennar and a few other ones, and what I went on there and saw is that a number of these home builders are at actually near 5-year highs.
Yeah.
And this year to date, all of them are up. They're up this year to date, even though home sales are slowing and higher mortgage rates, there's fewer sales, but yet the home builders are up year to date. That doesn't make sense. It means people are buying in at a time when they should have been selling, but yet they're buying in and it's making people money. And this could be more of these hedge funds buying in and pushing these higher. And so I would not be buying in after them.
So what's happening, actually, the thought process behind this, and this is actually, it's funny you were going to mention that because the other company I'm going to cover later here is Lennar as well. With existing home owners not wanting to sell their houses because they don't want to give up that 3% interest rate, what's happening is the people that are actually trying to buy houses right now are turning to new home builders. First and foremost, because they're motivated sellers. Once they build a house, they want to sell it and they want to move on to the next project as quickly as possible. So they're motivated. They will negotiate. They're not going to be an existing home buyer that'll put their house up on the market, have, maybe a home viewing or two or whatever, and then decide, never mind, I don't want to do it. These people are going to sell. So there's negotiations that can happen, but they're going to try to sell it. So a lot of new home buyers are actually going to new home builders, and they're picking up the slack.
That makes sense. That makes sense now.
The first 6 months of this year really saw an uptick in new home sales for these people in specific hot markets like Texas and Georgia and Florida. And Green Brick Partners, they have a big advantage here because they're in Texas and they're in Florida. So that's huge for them. That's fast growing markets, and they're in Georgia as well. So they had a killer first quarter, and it gapped the stock up about 20% in May. And the co-founder and CEO Jim Breckman said in a statement during the time, "We're pleased to report that Green Brick kicked off 2023 with the best quarter results in our history. We delivered 761 homes, which was a record for any first quarter. Home closings revenue increased 24% year over year to $449 million. We were able to sustain high home building margins across the board at 27.6%. That was one of the highest among public home builders in the first quarter and is up 140 basis points sequentially. So the stock gapped up about 20% since giving back a decent amount of those gains, but not all of them. And when you look at this company here, you see a decent amount of value in it, as far as the price to earnings ratio being fairly low. Price to sales is fairly low, and so is price to book. Debt to equity on this is very low as well. So it's a very good run company. The question is it a value trap now? Because have we priced in a lot of the growth that might happen? And it actually looks like the market's not expecting much more growth from here, because you're looking at a price to earnings ratio of 8, which is held down by what seems to be uncharacteristically high sales for the first part of this year. Meanwhile, though, for the quarter that ended in June 2023, they reported a revenue of $456.29 million. That's actually down 13.1% year over year. EPS for this previous quarter came out at $1.63 compared to $2.08 for the quarter a year earlier. So there's a possibility that these new home sales here, at least for Green Brick, have peaked. And when you look at the most recent quarters, there's some good things, but then there's a but on the other end of it. So new home orders up 50.8% for the quarter and 64.8% year to date. But new homes delivered number was down 11.1%. Residential units came in with a revenue of $454.4 million, second highest in company history, but total revenue was down 13%. I think we missed this train out of the gate, and I'm thinking I'm just going to let it go because there's just too many, ifs on this. The macro environment that we're in might not last. I think that, if you wanted to jump into it, you'd be betting that high interest rates are going to last for the next, 12 to 24 months, and that we're going to have a soft landing, because if we go into a recession, then all of this gets washed away.
I agree with you 100% on most everything you're saying here, especially the fact that this has already moved. You missed the boat on it. Don't chase the dragon, as we say on the show. Don't try to catch something that's already made the move, because there's no most of the time you're going to lose money, not make money. However, I actually do see interest rates staying higher for at least a year to 2 years. I don't see them dropping, because Jerome Powell has gone on TV many times and said that he's determined to get inflation and to fight inflation and bring it down to 2% level, to under 3% level. And
Right.
that's his goal. So we are going to see higher rates longer.
So if you want to momentum invest and jump on this train, the bet here would be that we see higher interest rates for longer, and that this quote unquote new normal lasts, a decent amount of time. If that happens and we have a soft landing, then people are going to continue jumping on the new home builder train, and buyers are going to continue going to new home builders because existing homeowners are going to continue not to want to sell. The only thing that keeps me away from buying this company or from Lennar is that if that is not true, then all of a sudden we've got two, I think, at that point in time, overvalued companies in a unfavorable macroeconomic situation.
Gotcha.
All of a sudden that 8.3, and it seems like, honestly, that the market's kind of betting on that, because if you have that kind of growth with any of these companies, having a PE of 8 makes no sense whatsoever.
Yeah, you expect a PE, that kind of growth, and you're expecting even that growth to continue. PE would be around what, 30?
Yeah, I would. Yeah, it's 30, and would be probably about right. And
you're buying in the future growth at that point. You're not buying in the current growth.
Yeah, so that leads me into the second company here, And these are, by the way, these are the two best performing hedge funds that I could find. So Greenhaven Associates CEO Edgar Wackenheim III. Go ahead, Dave.
So my question is, you're throwing me off of that, by the way, but my question is, if these are the two best hedge funds that you could find right now, quickly over the weekend or what have you, whenever you started researching this, what was their ROI?
The last 12 months for Greenhaven, for Einhorn's company, was a 54% return over the past 12 months, which is really high for a hedge fund.
Nice.
And then when you look at Greenhaven, I guess they, like to name themselves green. I guess that's, good for business. Green like
Hey
money.
man, the only green is money, right?
Yeah, right. So Greenhaven Associates is, if I remember correctly, I didn't put this in my notes for some reason, but it was about 34%.
Gotcha. Those are good returns. And by the way, if anyone listening, that only green is money thing, that's a line from a movie. So that is not something I'm saying. I'm not a greedy person. That's a line from a movie. But go ahead. Yes, those are good returns.
So Edgar Wackenheim III, he was born in 1937. He's an investor and CEO and chairman of Greenhaven Associates. He founded that company, which was a former branch of Central National Gotsman in 1987, and has worked there since as CEO. Okay, I do have it in my notes. They reported a 34.6% gain over the past 12 months. Largest holding here is Lennar, a company that Dave just mentioned. This is another home builder. And this is the theme that I found here. This one out of Miami, which is another one of those regionally hot markets right now. Price to earnings ratio of 8.32, price to book of 1.24, and price to sales of 0.96. On the surface, it looks like it's a value play right now on the surface. But, do you remember what happened with the tech stocks and the Best Buys, the tech retailers and such right after COVID?
Right. Yes.
All the price to earnings went way low. And
Yes.
that's because everybody in the market understood that the new normal, well, not everybody, but most of the people in the market understood the new normal wasn't really going to be normal. So, Best Buy, even though it was having like one of its best years of the stock market in a long time, its price to earnings ratio was like 8, right?
Yep.
And then a lot of these other tech companies had the same thing happen to them. And that's because earnings shot up astronomically high in a way that you don't normally see and you probably won't see again. And investors kind of caught on to that, like, hey, I'm not going to trade this up because it doesn't make any sense when you're looking at the years 2023 and 2024.
Yep. Exactly.
And that could be exactly really what's happening here with these two companies. Now, when you look at Lennar's most recent quarter, revenue from home sales decreased 2% in the third quarter of 2023. Revenues were lower primarily due to a 9% decrease in average sales, partially offset by an 8% increase in the number of home deliveries. So, decrease in average sales price there for them, but an 8% increase in orders and deliveries. So new home deliveries increased to 18,559 homes. This was the third quarter of 2023. And that was an increase from 17,248 homes in the third quarter of 2022. So we're actually seeing growth here from them on that end. Average sales price of homes delivered was $448,000 compared to $491,000 in the third quarter of 2022. Gross margins on home sales were $2 billion, 24.4% is what that equals, compared to $2.5 billion, or 29.2% in the third quarter. Small decrease there. During the third quarter of 2023, gross margins decreased because revenues per square foot decreased year over year as the company priced homes to market. And this was partially offset by decreasing cost per square foot due to lower material costs. In addition, land costs increase year over year. Now, what they're forecasting here, new orders, 16,200 to 17,200 new orders for homes, so a slight decrease there. Deliveries in between 21,500 to 22,500. Average sales price consistent with quarter 3 2023. Gross margin percentage on home sales will be flat at 24.4%, and SG&A as a percentage of home sales, 6.7% to 6.9%. So it looks like it's going to be a rather flat quarter compared to quarter 2. Once again, I just kind of think that this seems to be peaking.
Gotcha. It based on what you're saying, and I like the comparison you had there with Best Buy and them, and the PE ratio, and explaining that in detail. That does show that investors and hedge funders and the investment banks believe this is peaking, and they're not going to put in any more behind it. They're going to ride their wave because they invested early, and they're going to enjoy their return on profits, but they're not going to put any more in.
So you used a key phrase there. They invested early. And that's what these guys often do. The fact of the matter is that nobody's really a true market wizard to foresee the circumstances that arise. But what they do with these hedge funds, they invest in these companies when they're at a value, right? When they've been beaten down, when nobody else wants to buy them, but they still see the value themselves. So these companies have been bought. I couldn't find the dates of the initial purchases, but they were probably years ago, right? This wasn't something that, most likely at least, that either of these guys looked at and predicted it was going to happen, rather than buying the companies at a decent price where they said that, company fundamentals are worth much more than what they are. They probably bought them a couple of years ago and then just happened to be beneficiaries of this trend as it happened.
There you go. I mean, hey, a win's a win.
It is. And there's nothing wrong. That's exactly how you should operate the business. You're not, nobody here is a psychic. Nobody's reading palms. Nobody sees, everybody thinks these guys are market wizards with all kinds of insider information. Oftentimes it's not the case. You do see situations sometimes with like Warren Buffett buying into oil at the right time. But oftentimes, like I said, it's just, they bought these companies, they diversified their portfolios, and they bought into these companies when they were at a value price. And so, they've got exposure to home builders, they've got exposure to consumer durables and to staples and all of that stuff. And so when those things go on a tear, they benefit from it.
Yeah. Yep. 100%. But I mean, the Oracle of Omaha is the Oracle of Omaha for a reason. He's an Oracle, I would never, at that time he was buying Oxy. I would never have bought Oxy, but I would have got it wrong. That's why he's Warren Buffett and we're not.
Yeah, I wouldn't have. And, I missed this train. I wish I would have understood what was going to happen with this, but I think there was no real way to figure out that we weren't going to be in a recession by now. And this is a trend that I wish I wouldn't have missed, but I don't really blame myself for missing either.
Hey, here's how I look at this. It's a learning event. You see the signs, you figure the signs out, you put them together, and you look out for them for next time.
Yeah, because
and that's something to do.
I mean, this is probably going to happen again within our lifetimes. Interest rates go up and down. That's what happens.
Right. Cool. All right, man. Are you ready?
It should be noted too that Greenhaven also has a large ownership of DR Horton.
Of what?
DR Horton.
DR Horton. Oh, yes. That's another big player. All right. Cool. Are you ready, Brandon? Are you ready now? Yes. Okay, cool. Because I got 4 good articles today, and I believe 2 of them we'll speak about for a few minutes, but the other 2 will probably burn through real fast. So let's start one of the fast ones here that I believe we're gonna, it's gonna 1 minute. We're gonna have a conversation. That's it. This one was a Reuters and Newswire today at 12:20 p.m. Eastern time. There's no known author. It just says Reuters top news. International Longshore and Warehouse U.S. Dock Workers Union files for bankruptcy. So this it's a major union here. It filed for Chapter 11 bankruptcy protection, resolve a pending litigation with the Oregon affiliate of International Container Terminal Services, Inc. Woo! Basically, what they go in the article to say here is they use Chapter 11 because they can no longer pay the attorneys or pay for legal fees to fight off this litigation and lawsuit by them. So now they're just going to go in Chapter 11. What's going to happen with their 4,000 members across the United States and Canada? They don't know. They have to see what's gonna happen. Even though they ratified a 6-year contract for them, improved pay for employees at 29 ports stretching from California to Washington State. Who knows? There's a lot of employees here at stake. There's a lot of issues, but they said the lawsuit's just too much. They can't afford to fight it anymore. Thoughts, Brandon, on if that's going to affect imports, shut down containers coming in, or what?
I have to tell you, like coming from the retail business, now being in the freight business, I am so sick and tired of West Coast port strikes. It's just getting to me. It's driving me crazy. Can we please make this stop and have a long-term solution somewhere so that our supply chain could be actually, operational? That would be just wonderful.
Well, they did have a 6-year contract that was ratified, but then they got sued and they said they can't afford to run their business anymore because of the amount of the lawsuit, and they can't fight the lawsuit because of paying for attorneys.
Unbelievable.
Right? And when they filed for Chapter 11, they filed saying that they are only worth $1 to $11 million. And I was like, wow, are you guys like month to month here paying the bills? Because your pension fund should have more than that for that many workers.
Where are you hiding that money at?
Exactly, man. It's underneath Hoffa.
Right.
All right, so that was one of the quick ones. I'm worried about the ports of that one because that's a scary one. And
It's a constant thing on the ports, though. It seems like every year there's something new, especially on the West Coast.
Yeah, and the longshoremen is just a strong union. Sorry, and the reason why it's a strong union is because if the longshoremen strike, then no containers come in. They just nothing gets unloaded out of the docks. The docks shut down. That's why they're strong. They have a very pivotal part of how our supply chain works. And so their contracts, your new contracts, they don't usually go on strike because the companies usually give in to what they're asking. Unless they're asking too much, then they go on strike, then they go back and forth. It's not the only union out there, so I mean, there's other options to go through. But I just thought it was a good story, and you might make you think about investing in some of these like JB Hunt might take a hit if the ports shut down again.
Yeah.
So buying opportunity. Moving on to next one. This one is a Reuters newswire for 5:17 p.m. on yesterday. So 9:30, 2023. The headline reads, EU examines NVIDIA-dominated AI chip market's alleged abuses. The European Union examined alleged anti-competitive practices in chips used for artificial intelligence, a market that NVIDIA dominates, right? So NVIDIA has a current 80% market share. They declined to comment on this. The European Union are looking into this. French authorities have also been interviewing market players on NVIDIA's key role in AI chips, its price policy, and the shortage of chips and this impact on prices. Quick thoughts, Brandon.
So I just want to know what their evidence is. When you have a company that's this dominant in any industry, there's always going to be, some possible anti-competitive actions that are happening. In fact, I think most of the time in any industry, there's always anti-competitive actions happening because you don't want your you don't want your competition to get a leg up on you. That's just part of the industry. The question is, did they break the law? I don't know. If they did, they'll probably get a slap on the wrist.
Well, here's my only thing to this and to the European Union is it NVIDIA's fault that they invented a chip that allows people to process AI at the speed they need it to, and nobody else was able to invent the same chip? How is that NVIDIA's fault?
Not at all.
They invented it. They said, hey, look what we created. You have this chip now that you guys can run your programs you've always wanted to run, but we didn't have the computing power previously, but now we do. That's not NVIDIA's fault. They own the market because they have the chips and nobody else. Like I said on the show, anybody else who they're building competition. Meta is investing in company to build competition. Microsoft's investing in companies to build competition, but they're minimum of 2 years away from just building the warehouses, let alone have them up and running. Just building the warehouses to compete. They're at least 2 years away, and that's not NVIDIA's fault at all.
No, and here's a mind-blowing revelation for some. Every once in a while, you'll have a really good company dominate their industry because they're a really good company.
And that's exactly my point there. I don't think this is going to go anywhere. Even in the article, it says This is early stage investigation and may never result in a formal probe or penalties. That's what the report added as well. So I mean, I don't think it's going to go anywhere. I find it crazy that the EU thinks that they're going to go ahead and start investigating NVIDIA for NVIDIA being so good. All right. This next one, this was published today at 8:30 a.m. by Annie Nova. Annie is a reporter for CNBC, and the headline reads, "Student loan bills resume for 40 million Americans, how it could shake the economy." Right? So if you go on down here, you read all the numbers. They go into more numbers. They go into more details on here. They talk about like what some of the CEOs and companies are saying about this. Let me give you some of the numbers from here that make you, before I let you speak here, Brandon. But 70% of borrowers, so they went ahead and they surveyed about 600 of these student loan debt people and their situation, and they asked them certain questions. One of the questions they asked was, will you shop more often at discount retailers due to student loan payments restarting? 70% said yes, that they're going to shop at more discount retailers such as Walmart or Dollar General. Those are going to be the ones that they go to, right? Scott Munchkin, founder and CEO of R5 Capital, a consumer research consultant firm, estimates that starting in October, around $7 billion to $8 billion per month will be reallocated to student loan payments. So that's going to come out of the retail sector. So the retail is really gonna suffer for this. So, right? Jeff Gannett, Macy's CEO, said, "I think there are some headwinds coming, particularly with student loans at expiration of the loan forgiveness." The CFO of Target said the upcoming resumption of student loan repayments will put additional pressure on the already strained budgets of tens of millions of households. Another question asked to these consumers when they surveyed them: will you delay big ticket purchases due to student loan payments restarting? 70% said yes again. So the average, the typical student loan bill is around $350 a month. But 10% of all borrowers have a payment of over $700 a month. Brandon, initial thoughts?
That's a lot, but I don't know. I just don't have a bad feeling about it, and I can't really pinpoint why. I think that probably a large portion of these people are just going to defer, and I don't really know how many times you can defer your student loans payments, but you can do that if you could say, all you have to do is call them and say, "Hey, I can't afford this." And they'll say, "All right, we'll knock it down the road 6 more months." At least that's how it was in the past when I had student loans. So you could just say like, "Hey, I can't afford it. Oh, we'll do it, 6 months down the road, we'll restart them again." It just kind of happened on a large scale this time because of COVID, but I wonder if they're able to defer again, and then how many people are actually going to pay the student loans. I don't know.
Yeah, so in the article, Brandon, if you read the article, they give a few different scenarios that they talk to individual people and what happened. And it's a good article to read to get some of these numbers. There's too many numbers to read. But basically, majority of these student loan borrowers that they surveyed or interviewed, instead of taking that $350 a month and putting it into a savings account, waiting for the student loan to start up, what they did was they got into more credit card debt and other debts, or they bought houses or cars, and that $350 a month is now going towards that. So when student loan repayments start up, they don't have it because they're paying down the credit card they took and just use that money towards that. So they weren't smart with their money. I personally know a number of that are friends of mine or acquaintances of mine that took their student loan payment because they weren't allowed to make their payment. So they just kept putting it into literally a savings account. Once the student loan payments resumes, they're just going to take that and they're going to do a lump sum payment, boom, on their student loans, and they're in great shape. But the people who said, "Hey, I don't have to make this $350 payment anymore. Let me go ahead and buy clothes or a car or all these other things," that was really generating the economy, keeping it going. I mean, they're the ones who are going to be hurt. So it's all about the American consumer lack of financial education is what I believe it is.
Yeah, and the future me syndrome. It's a problem for future me.
Yeah, and that's what's going to cause this. But the fact that the CEOs are on here saying that this is going to be an issue, that's concerning, because then now they're admitting that this is going to hurt our numbers, especially come the holiday season. So that means you're not going to see a strong holiday numbers because of this starting back up.
Yeah, I think it's going to be that, and I think it's going to be inflation too.
The combination is what's going to kill it. All right. Last one. You talked about hedge funds and CEOs of hedge funds. Well, I got one that's a very controversial CEO, and he's made lots of news of hedge funds, and he's made lots of news in the past. He's gone on to on-air spats with other CEOs of hedge funds over the likes of Herbalife and so forth. Now, Brandon probably already knows who I'm talking about, but I'm talking about Ackman, Bill Ackman. So this is a headline from Reuters. It was this morning, 10:49 a.m. today. The headline reads, Ackman's Spark, S-P-A-R-K, it's an acronym, is seeking new deals with private companies. So basically, Pershing Square Spark Holdings, they got regulatory approval from U.S. regulators for distributing special purpose acquisition rights to non-private companies. So they got approval to do this. So they're targeting companies that seek to raise a minimum of $1.5 billion in capital. So that means that Spark Holdings has $1.5 billion at least in capital and cash on hand, ready to fund companies that are private, not public companies. In here, they go into the interview and everything, and they talked about what some potential companies you might be going into business with. Bill Ackman even said that he would consider a transaction with Elon Musk and X, and talk about where they were at. But Elon Musk did not comment on that, whether or not. So what do you think about Pershing Square and their Spark Holdings now saying, hey, we have U.S. stamp of approval. We're ready to fund your company, and if it's private.
Well, it'd be a good idea. He's a really smart guy. I mean,
well, yeah, you don't get to be a multi-billionaire dealing with cash and not be a smart person.
Yeah, it's just listen. He bought Google at the same time I did, so
right. So there you go.
Intelligence and mine.
He's also had some bad deals, like the Herbalife. He's still holding.
Yeah, that's bad.
I think he's down a lot on that, but he's like, I'm in cash. I'm holding. He doesn't have to sell you. He's not on margin, so he could just hold forever.
Right. I don't know why you would do that, but yeah, I think. And listen, everybody's had a bad deal. I've had stocks that I've sold for large losses, but your gains. The point is that your gains make up for all of that. Yeah, I would go with. I would take it if I was a company and I had the ability to access that. I would definitely go for it.
Right.
He's another one, by the way. I think he's calling for a soft landing now, isn't he?
Yeah, and to me, with when you look into, all right, so he's taking advantage right now of high interest rates by offering companies this cash and liquid to keep their companies afloat. The problem was that it's a special acquisition setup, and so he had to get U.S. regulatory approval to go ahead and do it with non-public companies, with private companies. Right. So he got it, and so he's taking advantage of these high interest rates, because now he can say, "Look, I could loan you this $2 billion, but you're going to pay me back 10%." He's going to rake it in on these deals, provided that the companies don't flop.
He's going to be an advisor on them, though. Then, right?
Yes. Yeah.
So, I mean, I think it's still worth it at that point. And
so, do you buy Pershing Square? Is Pershing Square?
So the thing is, they traditionally despise SPACs, but right now there's a decent amount that are actually at value. So I'd have to look at the numbers to it. I generally don't think that SPACs are a good idea, but nobody likes them right now. Nobody likes SPACs right now, and so you might be able to find a good value in them.
I mean, you did a whole show about how they were awful.
Yeah, that's when they were like in a huge bubble. We had a huge SPAC bubble at that point in time.
And you just came out to pop it. You're like, no.
Yeah. I still like, if the traditional IPO market was hot, I would still shun SPACs, no doubt, but it's not. So
there you go. All right. So those are my headlines I have. I hope everybody's listening. We thank you for listening. Now, keep on our social medias. Brandon and I have been really posting way more than we usually have. We're going to continue to try to drive that. So share it, enjoy it, like it, subscribe, do whatever you got to do. But Brandon, final thought, man. Final thought.
So actually, it was watching Bill Ackman the other day. I broke my CNBC fasting that I had going on. I still do, really, but I broke it to watch some of Delivering Alpha, and I saw him on there, and he's calling for that higher interest rate environment to last for a long time, just like you just said. And it seems like, at least he didn't say soft landing, but it seemed like from what I was watching him that he thought that we might be going into a soft landing. And so if that's right, then maybe still new home buyers, if you want to momentum trade it, then that's fine. But yeah, and he killed the high interest rate thing, by the way. Like he really did. He saw that coming and he made money on it. So good for him.
Yeah, I mean, some of these guys get it right sometimes, right?
Yeah.
All right, guys. My final thought right now is I'm over here pulling up my stocks. Apple iPhone 15 overheating, causing issues. They're already having problems with their new latest iPhone. Not going to be good for the stock come Monday morning because this is news that broke over the weekend. So we'll see how that trades Monday morning. But
well, hold on. They just released a software update on iOS, so we need to see if that actually fixes the issue or not.
Oh, there you go. So still maybe a rough morning Monday morning, but I think it shows a buying opportunity if it is.
Yeah.
Personally, because it's just a software update. I am still every week slowly adding to my Tesla position. I do not believe it's bottomed out yet. So I believe it's going to go down. So I'm buying as it goes down. And then as it turns around and goes back up, I will sell. So that is my theory with that. So I am not saying it's not going to go down. I'm saying I'm expecting it to go down some, but I'm slowly purchasing in every week right now. I'll let you know when I finish my purchase of Tesla. But that's what I'm looking at, guys. I don't really have much else as far as calls or anything. Just say, take the research that we give you here, do your own research, take time, look for value in companies. That's what Warren Buffett does. That's what all these other businesses do. You try to find the value company and you invest in it heavily. That's the best way, I believe, in order to do it. I've been doing this for coming up on 20 years, not quite 20 years yet. I'm not that old yet. I do have a birthday this week, but I'm not that old yet. But a long time. And so I do it at a much faster rate with my day trades, but that's very hard to do. Very hard to do. People that go online and try to tell you that they trade with 80% correct rate, I would call them out on that every day of the week and challenge them to prove it. Because that's very hard to do, even for me.
Yeah.
So please, do your research, take your time, find value companies. That's all I got, man.
Right.
We hope you enjoyed what you heard. And as always, we hope we've been entertaining, educational, and uplifting because we want everyone to make money. Have a good night.
Value companies with pricing power. Have a good night.